There's a growing divergence in the economy. The private sector just can't keep up, and government spending can't fix all our problems. The evidence is now becoming clear in the data. There's two key metrics we're going to show you today that demonstrate exactly that. This is construction spending. It was reported earlier this week. There's a pretty stark difference between what's working and what's not. Here, the yellow bar shows a 6.6% rise in education construction. That's on a year over year basis. We also see quite a bit of strength in transportation construction, up over 7%. To the downside, 3.5%. That's commercial construction. Also, residential construction, down 4.7%. Here's a closer look at education construction. It's been holding steady. Lots of spending in the education projects, and that doesn't seem to be waning. How about transportation construction? That's also very close to recent swing highs. Certainly a lot of strength in the sector. However, the bad news, commercial construction, that's down. To be exact, this month's update, that's down 3.56%. Also, residential construction, that's the lowest low we've seen in quite a while, dipping deep into negative territory at this point. So the metrics are as follows. This is number one, residential construction. There's strength in transportation and education. That's likely driven by public investment, though, infrastructure bills. On the other side, weakness in residential construction and commercial construction. That's related to the housing market, possibly due to high mortgage rates, affordability issues. However, it's also in the private sector, and that is really the theme to take away from this. The public sector strength is far outweighing the weakness and masking, to some extent, the private sector. We also have manufacturers' new orders. The strongest sector, that's up over 8%. That's capital goods. That's investment in machinery, uh, computers, things that make the factories work. And that's pretty good. Also, new computers, electronic parts, that's up almost 3%. However, the bad news to the downside, motor vehicles, that's down over 3% on a year over year basis. Here's durable goods. This is the production of appliances, aircraft, for example. That's doing pretty well these days. This month's update on a year over year basis, 3.21%. Here's capital goods. Again, this is the expenditure for new manufacturing plants and machinery that goes in there. That's up over 8%. However, the bad news again, and this is quite troubling, motor vehicles and parts. This is down 3%, 3.2% to be exact. And what's troubling about this is that this follows that surge to the dealership in order to try to front run the tariffs. We all bought new cars expecting them to go up in price. Well, it looks like the manufacturer's new orders are starting to wane. So here's the takeaways from the manufacturer's orders. There's strength, capital investment in durable goods and capital goods. But a lot of that, again, is due to government spending, aircraft, for example. On the other side, there's a lot of weakness in the auto sector. And this is quite surprising. Again, following that surge as we all rushed to the dealership afraid that the prices for cars were going to go up as a result of the tariffs. The overall theme here is that the public sector investment far outweighs and in some cases is masking the private sector. However, that can't last forever. The economy, for the most part, is built on the private sector, and that is troubling. Economic calendar, ADP employment on Wednesday, ISM services, Thursday, initial jobless claims, and then Friday, we get the really big employment number. And that's important. We want to see if the Fed funds futures move at all. So far, we're not anticipating interest rate cuts anytime soon. We'll be sure to update you along the way with anything interesting. We hope this has been helpful. We look forward to seeing you back soon.